It seems to me in the world of performance, which is talked about every day in the paper as if it's important every day, they're missing the point. Like, if you buy something that's great, it should last a long time. That's the same thing for buying an investment portfolio. I mean, these things are no different, but there's a lot of money to be made in turnover and quick activity, and that has nothing to do with making good investment decisions, and it certainly has nothing to do with providing great performance, because most of those people don't provide great performance. So you have to have a discipline. You have to understand that what you're doing is going to be longer term in nature. You're not going to turn over things a lot, because that just adds costs, both from point of view of trading and taxes and all those things. So you want to buy stuff that lasts. And what you don't want to do is believe all you read about index funds and ETFs and all these things, because let me tell you, the simplicity of these instruments is this. Yes, they're cheap. Yes, they're accessible. And yes, billions of dollars is pouring into them all the time. But they are not risk protected in any way, shape, or form. They represent the stock market. We think if you can segregate the right parts of the stock market, you're not nearly as much into the stock market as you were before. In the dividend space, dividends produce 50% higher returns than non-dividend paying stocks. So why are you buying the whole stock market? Like, there's no sense to us, because we, again, believe in evidence. We want to make sure that works. It works. It's worked for 100 years. It's not new. It's boring. We know it's boring, but that's okay. In the index world, when things go down, think of it this way. So everybody says, okay, sell. Every single index fund has to keep selling. That's what happens. It's not really that complicated. It happens. They just keep going down and down and down and down, because everybody's rushing ahead of everybody else to get the next price. At the end of the day, 4 o'clock happens, the markets close, everybody goes, thank God that's over. But they don't recover very quickly, because you've got the whole basket. You haven't chosen well, you've chosen everything. And if you choose well, like we do, and you focus on 22 stocks, markets are going to do whatever they do day to day, but long term, those companies are going to outperform all the other things. And you recover much more quickly with good companies, and you make all your money saving money on the downside. You never want companies to disappear. When things go down sometimes, all the weak sisters never rise again. We don't want those. We want every one of our companies to simply be battered by the mania of the day. That's what happens. We can't stop that. But for us to emerge, because finally everyone goes, oh, quality always rises. It always is the same case. So we're comfortable with volatility and whatever bad words they associate with the ups and downs of the market. That's okay. It happens. We can't stop it, but we can participate in it profitably by buying companies that will recover faster than index funds or ETFs and leveraged ETFs and all the crazy things that people buy today.